Welcome to Fisher Webinars. The following is a recording of Deintegrate or Reintegrate, Trends to Watch For in Pulp Integration, originally recorded on Thursday, October 19, 2017.
My name is Clay Enos. I'm a senior consultant here at Fisher International, and this webinar will be on the topic of trends to watch in pulp integration. So what we intend to cover today in this next 30 minutes or so is to run through a quick look of the global pulp market. And we'll keep our eyes specifically on forces and trends that may cause disruption to today's status quo. Specifically, we'll look to examine the behavior of producers and consumers in the market. We'll build a screen to identify candidates who may be likely to deintegrate with their existing pulp assets. And conversely, we'll analyze markets in which we're seeing increasing levels of integration in some grades that have traditionally been non-integrated or less integrated producers. So let's start with a look at the global paper market. Here we're seeing that there are roughly 500 million tons of paper being produced globally today. This graph excludes market pulp production. Probably the most interesting takeaway here is the fact that I put at the bottom, which is that roughly 25% of the furnish required to produce that paper is acquired as market pulp. A little bit more on market pulp. On this slide, we're looking at the announced capacity increases we expect over the next 5 years. And as we've heard a fair amount about in the last few years, there's close to 30 million tons of market pulp announced to come online over this period. On the other hand, we have 60 million tons of paper. Much of the 30 million tons of market pulp will be consumed by the new paper production, but certainly not all of what's announced. And it's reasonable to think that there may be some imbalance over the next 5 years. On that topic, in fact, 2 years ago on this topic, Fisher authored a webinar. It's available on our website, and it discusses the realities of the balance between paper and market pulp, potential for oversupply in the market. And I'll summarize the findings of that webinar in a couple of bullets. Probably the most critical of those points are the first couple, where paper capacity tends to grow fastest in regions where the consumption of market pulp is also the highest, Asia Pacific being a great example. And in relation to that, but slightly different, is that growth also tends to be somewhat skewed towards grades that are more commonly non-integrated, for example, tissue. In addition, there are some practical considerations where a number of the announced projects either won't come to fruition or produce less than is initially expected. So with this in mind, again, the details are available on our website, but I'd like to move forward with our analysis under the assumption that today's supply and demand balance for pulp is reasonable. And so with that assumption that supply and demand are fairly balanced today, what would disrupt the status quo in this market that we know to be global and complex, full of moving parts? And in the interest of time and what we can cover in the next 30 minutes, we'll look at two key trends that may impact the balance. And again, they are the trend towards existing producers choosing to close their pulp assets, or conversely, a movement in some markets towards a higher level of integrated players. So no further ado, that's the foundation. Let's take a look at our two trends. The first being, are there any candidates out there we can identify that are likely for deintegration? We'll start our study here with a quick screen, and the screen's designed to identify any grades where it's highly unlikely that we'll see integrated producers for reasons that make it infeasible. And the takeaway here is that the top two grades on the left, newsprint and packaging, today have very few non-integrated producers globally, either none or extremely few, whereas printing and writing, specialties in tissue and towel have a much higher fraction of non-integrated producers, not only in regions such as Asia Pacific, but across the breadth of most regions. So for the balance of the study, we'll focus on printing and writing specialties and tissue and towel products. With that decided, let's talk about the big question of why might an existing integrated producer decide to operate in a non-integrated fashion at all. And I think it probably boils down to this first bullet, which is purchased pulp may be a more cost-effective solution. Of course, it's not a simple analysis. We have the actual cost of purchased fiber when compared to own make production costs, but you have to consider ongoing CapEx spend that might be saved if the pulp mill is closed. On the flip side, you have some additional cost with deintegrating a pulp mill, for example, loss of internally generated power if we aren't burning black liquor, and costs of rewetting, pulping, handling costs. So this all comes into play when we're considering the cost structure. But there are some other factors to consider as well, and we can get far down into the weeds here, but some examples might be a possibility of avoiding a cost, a major capital expense perhaps, or site-specific operational considerations. For example, perhaps a site has an inability to throttle back a recovery operation without extensive capital, or configuration of the site prevents handling or storage or utilization of market pulp. So what I'm trying to demonstrate is that we can get very detailed and down into the real granular analysis with a study of a topic like this. And what we're looking at on the screen is an example of some of the data Fisher has used for similar studies in the past. For the rest of our time today, we won't be going into this level of detail. Instead, we'll take a somewhat higher level look, and we'll use a tool called viability benchmarking. Viability benchmarking, for those unfamiliar with it, is a tool that's available within FisherSolve. Really, it's an index or a ranking of producers within a subset of a grade segment or a grade and a regional segment. And it performs that ranking based on 5 key indicators, one being cost. So cash cost of manufacture is one indicator, another being scale or size, technical age, capital required, and an efficiency measure in terms of tons per inch of trim. What happens next is we perform regression analysis with a set of historical line closures over a good number of years to determine the appropriate weighting for each one of these factors, and that weighting will be specific for a certain grade grouping in a certain region. And we apply a weighting to assign an overall viability risk for each site, each finished product. So a way you can think about the viability index once all this work is done is that viability really represents the likelihood that a mill would close with a high viability index, a number of something like 7 to 10, describing assets at the highest risk of closure. So now that we've described viability and agreed that we'll use it as a way to screen sites, let's begin the screen. What we're seeing here on the slide is the 128 integrated pulp mills producing hardwood kraft pulp in our target segments of printing and writing, specialties, and tissue. I chose hardwood kraft simply to keep the subset of mills to consider a little bit smaller and more manageable. But we're starting with 128, and if we now add our viability factor and we filter for those mills who have high-risk pulp assets, we lower the number from 128 to 75. Further, if we're considering that these producers may want to operate in a non-integrated fashion, they'd need most likely high-risk pulp lines, but also viable low-risk paper assets. So if we add that factor to our screen, we now get a list of 55 sites across the globe. You can see some exist in North America, Europe, etc. We even see some in Latin America, which is somewhat interesting given the typical perception that pulp assets in Latin America are fairly low risk. So I'll ask you to table that thought for a minute, and we'll come back to it later in the presentation. So we have our list of 55. The next step in the screen would be to very simply see if we can get over that hurdle of cost, the first hurdle. And so we'll perform here a basic analysis where we compare the production cost of internal pulp, considering the ongoing CapEx spend against market pulp pricing, and see if it appears to be viable to cover these costs in addition with the negative costs associated with de-integration, working against economy scale, etc. That's what we've laid out here on the next slide, where we have a cost curve. We have cost of fiber production only here on the y-axis, and I've colored the 55 sites by region. We can see the Latin American folks over here by and large in the first quartile, producers in the Asia Pacific region over here to the right. And I've drawn a line across the cost curve at roughly $500 a ton, just to give an indication of where market pulp pricing may fall. Could be significantly higher than that or maybe lower in certain regions. But assuming it's in this ballpark, what we can take away here is that there are really very few producers who might consider de-integrating from a cost perspective, and they all exist in Asia Pacific today. So to summarize kind of what we've seen in this first half of the screen, it appears as though producers in North America and Europe are pretty lean and mean. We know that most of the producers in Latin America are. So it's probably fair to draw the conclusion that the global balance of market pulp is unlikely to change in the short run from de-integration by existing producers. All right, so part two. Now let's take a look at the inverse. Let's look at the potential for what I've called reintegration, or a movement towards more integrated producers within markets that are typically less integrated. That would be the three at the bottom of that very first slide: printing and writing, specialties, and tissue. So I talked about a trend, and this is the trend that I was referring to. What we're looking at here are a percentage of non-integrated sites in printing and writing and specialties by region. And the orange line highlights the trend we've seen in North America over the last 10 years, which is to less and less non-integrated sites. Stated a different way, we've seen increasing levels of integration in printing and writing and specialties over the last 10 years in North America. Logical question from this might be, will this continue? Will other regions see a trend like this? And to try to understand what's going on, I've built an illustration here with several cost curves that will help us consider what's really going on in that previous slide with the downward trend. So on the left, we're looking at a cost curve of today's coated freesheet producers in North America. To the right, we have a subset of specialty producers also in North America. I've drawn a line across the cost curve on the left, which is intended to indicate pricing. And we know a few things about coated freesheet. We know that there's demand decline, and we understand that that causes pressure, and it causes typically pricing to be on the floor, what we would call the floor price, or perhaps you might call a market clearing price. And what happens over time is demand decreases and that floor price will fall. The falling floor price pressures the high cost producers, no longer can make positive cash flow, and eventually they will be forced to exit. In that case, you saw that they were green bars, they were non-integrated producers, and so the entire group of coated freesheet producers becomes integrated in this case. Now there is another alternative, And another common alternative might be that an integrated producer who maybe isn't the high-cost producer, but a modestly high-cost producer decides they have the assets to play in specialty markets, and perhaps there's some additional margin to be had. Perhaps the trend of capacity is flat or slightly growing as opposed to declining, and so they might decide to exit. And if they did, it would look something like this. Tons would move over here. They may not be the lowest cost producer, but they're reasonable cost, first, second quartile cost. Of course, there's a follow-up effect here where there's an exit of producers on the right side of the curve. Those producers as well are non-integrated green bars. So in each of those cases, what we've described is a level of integration that moves towards more and more integrated players. Is it likely this might happen in tissue? It's the next question we'd like to consider. And I would suggest that there are trends in North America particularly that support the possibility. All of the trends I've laid out on the slide in front of us really describe a lowering of barrier to entry in these markets. There's a shift towards private label. It's forecasted to continue to increase year over year, which decreases the requirement for marketing power, brand recognition. In addition, we know that technology is available today that they can make it possible for most any producer to make just about any product at a varying level of quality. Further practical evidence is the continued announcement of new capacity. It suggests that players in the market behaving rationally expect to receive returns that exceed the cost of capital for new machines. So if it's reasonable to expect folks might decide to move into tissue and not just a movement from printing and writing to specialties, the next two questions we may want to consider are these at the bottom. Which mills might consider the leap, and what might that mean for existing tissue producers? Those are the next two questions we'll go through together. And so here on the next slide, we consider who might take the leap. And this screen is constructed much the same way the first ones were, but very much the inverse. So in this case, we're looking at hardwood kraft producers again, but these are the ones who have low-risk pulp assets in combination with high-risk paper assets. And we can see no shortage of potential candidates in regions across the globe. Well, that answers our first question. There are candidates. So what would happen to existing producers? I'm illustrating that again with a cost curve. And so here's a cost curve of tissue producers in North America. And we can see on the right-hand side, it's overwhelmingly non-integrated producers. Now, while that's interesting, in fact, quite interesting, it doesn't tell us the whole story because this market is significantly different than a printing and writing market. Demand decline isn't so much of a force. Pricing isn't necessarily on the floor. In fact, I would suggest there's likely margin for everyone in this space today. So we'll use our viability index once again, which is now a combination of a number of factors, all 5 of those factors, not cost alone, but whether or not a mill requires capital on an ongoing basis, what its scale is, and so forth. And it has the effect of moving some of the non-integrated sites here to the first quartile position and quite a broad mixture within the middle of the cost curve. Interesting to note, however, is that the high-risk mills, those who will be pressured first by new capacity coming into the left, are still predominantly non-integrated. So once again, we'll see an effect of more and more integrated mills and less non-integrated mills. With all that said, let's go back to the comment I made earlier. What about these high-risk producers in Latin America? And I bring this up because as I was building the slides and working through the analysis, I thought to myself, boy, that doesn't ring particularly true to me. How is it exactly that there are high-risk mills in Latin America? It's always talked about how large the scale is, how low cost they are. And so let me walk through exactly how that is. Well, it is true. This slide will validate the conventional wisdom around eucalyptus producers, where when we compare North America to Latin America, the low-risk mills are all to the left-hand side of the curve. These are the eucalyptus producers on the left, and the North American producers of bleached hardwood are on the right. I've simplified the curve by only including these two regions, but the story would be much the same if you compared Latin America to Europe or Latin America to Asia Pacific or other regions. On the other hand, if we look at a grouping of Latin Americas amongst themselves, we still find that we have a pecking order, and this is how we find high-risk eucalyptus producers. Somewhere in Brazil and Latin America, there's the best eucalyptus mill, and there's the highest risk eucalyptus mill. And it may well be that a number of these producers in the fourth quartile are low risk when compared to a number of other producing assets worldwide. When you consider eucalyptus in Latin America, there again is a ranking. So why have I taken us through this analysis? Well, it relates to where eucalyptus is consumed. And here's a graph that shows us exactly where it's consumed. So 30 million tons, give or take, being produced for market pulp. And as you can see, nearly all of that, close to 90%, is being consumed in the three grades we identified right up front as the most likely to move towards integration. Additionally, in North America, just as additional info, it's nearly exclusive to tissue. Consumption is predominantly in tissue. We're talking about eucalyptus. So, what's the point I'm trying to make here? Well, the point is that as we move towards integration in those grades, tissue, printing and writing specialties, it's likely to lead to some demand decline and some pressure to producers of eucalyptus. And while it might be tempting to think that, okay, I saw the North American graph and there were only a couple million tons there, and even if that all went away, how big a deal is that for 30 million tons of capacity? And I'd suggest that it's bigger than you may initially think. And the reasons are down here below, where if you think about the behavior of those large, low-cost, high-scale players on the left side of the curve, they're likely going to fight to keep their volume up, keep their economy of scale going, and preserve their operating rate efficiency. This behavior is really going to result in magnifying the issue for the high-cost players and resulting in a kind of a double whammy, where not only do those high-cost, high-risk players lose some volume to the folks on the left side of the curve, but they're also likely going to lose pricing on their existing customers, because price is a typical lever that the folks to the left side of the curve might use to preserve volume. Well, if we agree now that there could be some stress applied to particularly producers on the right side of the curve, maybe we think about what they're going to do next. If they're stressed, might they decide, well, I'm producing a product that's going into tissue. I know there's margin in tissue, and I'm realizing margin on my product, only the first step in a series of steps where margin can be realized. That's the sale of pulp. It's probably a sale of pulp to non-integrated producer. Maybe that producer's selling parent rolls to a non-integrated converter and realizing some margin. Almost certainly there's converting of that product into rolls or other products, and there's a margin there, and then there's sale of finished product. And if I'm a producer towards the right side of the curve, I might think, well, how do I get some of that margin? What can I do? Well, I understand, and perhaps they're thinking producing their own tissue is a way to achieve that margin. Well, conventional wisdom, I certainly understand that shipping tissue over long distance flies in the face of a lot of wisdom today. I would point out that there are producers who are successfully shipping parent rolls today, and for those who may be inclined to evaluate the possibility of producing tissue and shipping, it probably boils down to two alternatives here at the bottom for consideration, and that would be, does it make more sense to produce and ship parent rolls to the U.S. for conversion stateside versus if I add tissue capacity inside the U.S. and continue to ship my market pulp, produce tissue stateside and convert and distribute from there? So I've built a slide here, the next slide, where we'll talk through what that difference really is and see whether or not there is headroom that we can find to offset some of what's sure to be a premium in shipping cost. So here's what that looks like. On the left side of this cost curve, I've presented a weighted average of Latin American tissue producers' costs. On the right side is North American tissue producers' costs. And we're seeing here costs of manufacture excluding pulp. So we're looking at the costs including materials, labor, energy, and chemicals cost. And what becomes very quickly evident is that there's a significant cost difference in producing product today in Latin America versus North America. And the majority of this production is Brazil. In fact, it's roughly $200 per ton. I would think that for $200 per ton, with the infrastructure for ocean freight and market pulp expertise available in that region, there are folks who could figure out how to make this work. Okay, so we've been through most of the analysis at this point. It's been a bit of a meandering journey, perhaps even feel like we've talked in a bit of a circle. And I'd suggest that that's really because in a way we have. In fact, what I've done here is I've designed an illustration which I believe will show that what we've really described is a cycle of supply and demand. And I'll walk us through this cycle, and we start right up here at the top, which is where I think we've shown that we are today, where market pulp pricing by and large is unfavorable to deintegrating of existing pulp producers. So that pushes us down to this step in the cycle, and particularly in markets where there's pressure from declining demand, that the herd is thinned, the low-cost producers who tend to be integrated take over, tilts the scales towards them to some extent, and that is the reintegration part of the cycle, and that's where we are today in many regions and several grades. Moving down, the bottom of the cycle, where we are here, is the discussion over the last few slides where pulp producers become stressed, they consider options to maximize value from their installed capital assets, and perhaps they make a decision like to entry into the tissue market. Another likely outcome of this part of the cycle is price is reduced for market pulp as demand is declined. And that's the deintegration part of the cycle. If you think what happens after deintegration, well, non-integrated mills consume more market pulp, demand once again increases, pricing increases as demand increases, and we're right back up here at the top of the cycle. All right, so to close things up, maybe tie things together a bit, you'll recall that at the beginning of the presentation I asked what trends likely to continue. Now that we've been through the analysis, I'd suggest that maybe the best way to think about this is really a question of where am I on the cycle today? It's important to bear in mind that different grades, different geographical markets may exist in different points of the cycle, might also move through the cycle at different speeds. Additionally, let's consider that it takes only a relatively small shift in demand to impact the behavior of producers and of consumers of market pulp, as well as a market's movement through the cycle we described. It's above all, what I hope we've demonstrated here is that you can use the business intelligence tools you have at your disposal with FisherSolve to perform your own analysis of the market you're in and determine your own position on the cycle. So if you have any questions related to that or about how you might perform the analysis after attending our webinar, please don't hesitate to reach out to myself or to any of your senior consultants from Fisher for assistance.